Is the stability of the real estate market a myth waiting to be debunked? This question lingers in the air as we consider the tempestuous nature of the property market. Past market crashes, the unpredictable ebbs and flows, have painted a picture of a landscape that is far from stable. These seismic events have shaped the terrain that we navigate today. So, what's the truth? Today we delve into the minds of billionaire real estate investors to understand their perspective on the stability of the real estate market. What happens when those who've made billions in real estate start sounding the alarm bells? Imagine for a moment the likes of Warren Buffett or Robert Kiyosaki, renowned investors who've built their fortunes on the foundation of real estate. They've mastered the art of identifying property trends and capitalizing on them. But now, these titans are voicing concerns, sending ripples of unease through the industry. In recent interviews, these billionaire investors are expressing apprehension about the current state of the property market. They've seen boom and bust cycles, enjoyed the highs and endured the lows. But now, they're pointing towards a horizon that could be darker than anything we've seen before. These magnates are warning of an inflated property market, bloated by low interest rates and unchecked speculation. They believe these conditions are eerily reminiscent of those preceding the last major real estate crash. They're cautioning us that we could be on the precipice of a steep downturn, a fall that could reverberate through the economy and leave many unprepared investors in its wake. It's not a doomsday prophecy, but a call to awareness. It's a reminder to tread carefully, to reassess strategies, and to prepare for potential turbulence. The future is always uncertain, but when those who've weathered countless storms start to worry, it's prudent for us all to pay attention. These predictions from the titans of the real estate industry raise questions about the health of the property market. But what are the warning signs these billionaires are seeing that others might be missing? That's the question we're going to delve into now. Firstly, let's consider soaring property prices. It's no secret that real estate markets around the globe have been on a bullish run for a long time. But when prices rise too high, too quickly, they often come crashing down just as fast. This is because the prices are not supported by underlying economic fundamentals, but rather by speculative buying. This speculative bubble is one of the key warning signs these savvy investors are keeping an eye on. Next, we have the era of low interest rates. These rates have been a boon for buyers, allowing them to borrow more money at a lower cost. But this has also fueled an increase in property prices, as more money chases fewer assets. The concern is, what happens when these rates inevitably rise? Will buyers still be able to afford their mortgages? Or will we see a wave of defaults, leading to a flood of properties on the market and a sharp decline in prices? And let's not forget about economic instability. The global economy is more interconnected than ever before, and a downturn in one region can quickly spread to others. These billionaires are closely watching global economic indicators, from GDP growth rates to unemployment numbers, to gauge the overall health of the economy. A sudden economic shock like the one we saw in 2008 could trigger a real estate market crash. These factors, soaring property prices, low interest rates, and economic instability, are all interlinked. When they combine, they create a perfect storm that has the potential to cause a significant market downturn. And these savvy billionaires are not just watching these signs, they're acting on them, adjusting their strategies to protect their investments. With these signs in mind, it's clear that the stability of the real estate market may not be as secure as it seems. So, if a real estate crash is looming, how should investors prepare? The first tactic is diversification. Spreading your investments across a variety of assets can shield you from the full force of a market crash. You might consider investing in different types of real estate, such as commercial or residential, or in different geographical locations. Don't put all your eggs in one basket, as the saying goes. Another strategy is to invest in safe markets. These are typically areas with steady demand and lower volatility. For instance, properties in established neighborhoods tend to hold their value even during market downturns. Seek out these safe harbors as a form of insurance against the stormy seas of a volatile market. You might also want to consider holding off on new investments until the market stabilizes. This doesn't mean you should sell off all your properties and sit on a pile of cash. Instead, It's about being patient and waiting for the right opportunities. Remember, in real estate, timing can be everything. And finally, keep a close eye on economic indicators. These can give you a heads up about possible market downturns, allowing you to adjust your strategy in advance. In conclusion, while the thought of a real estate crash can be disconcerting, it's not a cause for panic. By diversifying your portfolio, investing in safe markets, and being patient with new investments, you can protect yourself from the worst of the impact. Preparation is key to weathering any potential storm in the real estate market. In conclusion, while the stability of the real estate market is under scrutiny, it's crucial to stay informed and prepared. We've heard from billionaire investors who've shared their insights and warnings about the potential for a market crash. We've deciphered the warning signs, helping you understand what to look out for. We've also discussed strategies to prepare for the unthinkable, ensuring that you're not caught off guard. As we navigate these uncertain times, remember that knowledge is power. Stay informed, stay prepared, and stay ahead of the curve.